private fund for real estate has reported positive returns in 2022, compared with around -25% for publicly traded U.S. real estate investment trusts. Public markets are down substantially, even after the recent rally. How could this happen? Same buildings, but different valuations. A gap has opened up between private landlords and real estate stock investors, the two-speed property market. It could be a challenge or an opportunity. At the end of the video, we will share our thoughts. This is V-Circle Future. Right now, if you own private equity, like REIT, do you feel you are probably a happy camper? Okay, don't be fooled. Private investments might still be showing green on paper, but many investments in that space are hurting just as bad as their public market peers. The gap between public market and private funds cannot last, as building values will be impacted by the same factors sooner or later, regardless of who owns them. While there are certain spaces that will still be in the green, most of the private market will have contracted, either as a result of real market deterioration, or simply as a result of valuation compression. These pressures are immediately visible in public markets. Stocks have traded down steadily over the course of the year, and private markets are not immune. However, many private funds have been able to show remarkable resilience so far this year because of the way they price their investments. Private equity often lacks transparency and slow pricing due to different reporting standards for private companies. Valuation can be subjective, especially during down markets when fund companies have no incentive to mark prices down and show underperformance. Let's take a step back for a moment to understand private marketing investing. First, we need to understand how public markets work. Company value is typically determined by the company's market capitalization, which is calculated by multiplying the total number of shares outstanding by the most recent price of a traded share. If the most recent trade price for a share was $50 and there are 1,000 shares, then we can assume the company is worth $50,000. Of course, this pricing is not ideal. It is entirely dependent on liquidity. A single share may trade at the current price, but a large buyer or seller will usually experience different prices. They buy existing shares at the current price, then the next higher price, and so on, to achieve their goal of buying/selling a large amount of shares and thus move the price. A great example of this is the recent FTX situation. FTX had a lot of tokens it held on balance sheet at a quoted value, even though it was impossible to sell all the tokens in the market at that price. Situations like that aside, the current price is usually a good indicator of a company's total value. When the company reports earnings or updates its financials, the price will adjust almost immediately to accommodate the new information. It's called transaction-based pricing. But transaction-based pricing can be misleading. A popular method of valuation is called transaction multiple pricing. It's to use a recent transaction multiple from a comparable company or property. Because when we use transaction-based pricing, private market pricing doesn't follow efficient rules. Equity values on statements aren't accurate due to lack of liquidity and transparency. Current values can't be seen from recent transactions, which may be from 9 to 12 months ago. Economy and business likely changed since then, so the recent price may not reflect the current value under transaction-based pricing. Meanwhile, when we use transaction multiple pricing, it may sound simple, but there are many factors to consider. Valuing a company or property based on current or projected earnings is one thing, but it can be difficult to find an appropriate comparison for an emerging company or a property with rapidly increasing cash flows. Step 3 is to understand the incentives of managers. The company through which you have invested your money into private markets or real estate has no incentive to see the value of their investments marked down. This would reduce their fees, erode investor sentiment, and make it harder for them to raise more capital. Therefore, they have the incentive to help the company look for ways to get a higher valuation. These could include aggressive forecasting, finding favorable peers for comparison, or even leading another round of financing to raise capital at a stable valuation. Right now, in the private markets and real estate, you can't avoid certain pressures, no matter how promising the company you invested in. Leverage is key for private equity and real estate companies to generate high returns. Higher exposure typically means higher returns, but the cost of leverage is a direct contributor to returns. The Fed's rate hikes have driven up the cost of leverage, which hurts the return profile of leveraged funds. Private investments are long-term, with returns expected after 5 to 10 years. Discount rates, connected to interest rates, impact their value, as the higher the risk-free rate, the more their return needs to be discounted. The valuation shift in markets over the past year is largely due to this discount rate shift, which affects private markets too. Business risk is another pressure. The Fed is trying to slow the economy and companies face more risks than a year ago. Valuations should account for this. In the real estate market, transactions that are taking place suggest values are heading south. Last is the liquidity run. Investors need liquidity during a market crunch to avoid short-term obstacles. Take Blackstone Bright for example. A growing number of Bright investors, especially those in even harder-hit Asian markets, sought to cash in on their Bright shares, which had held their value. Blackstone quickly addressed those concerns by taking steps to increase Bright's liquidity. It cashed in on its casino investments in Las Vegas, selling its stakes in 2 properties to its partner for $1.27 billion in cash plus the assumption of the associated debt. Meanwhile, in early January, Bright got a vote of confidence after UC Investments agreed to buy $4 billion in its shares, which it will hold for at least 6 years. So, right now, your private equity and private real estate investments should probably be facing markdowns like their public market peers. But that's okay. If you're invested for the long haul, you invested that money with a 5 to 10 year timeline in mind, and a downturn shouldn't change that. Here, let's emphasize our 2 thoughts. The first thought is that during a market downturn, the major challenge is liquidity challenge. Companies that have been through downturns multiple times and excel at this will be the final survivors. Finding a sophisticated and experienced fund could be a better choice. The second thought is that this is a great opportunity to invest in this space if you haven't done so already. Historically, returns for private funds seeded during a downturn have been excellent. During a market crunch, many people need liquidity and face short-term obstacles. The inefficiencies in private markets are amplified. At this time, you may find a good price to invest. It can be lucrative, but comes with risks and is not suitable for everyone. So make your final decision on investment and find a better choice for you. Thanks for your watching. This is V's Circle Future.